All right, the market started that expected pullback, especially for this time of year and this week in particular, post-September expiration. So we're going to break that down today. My home office here, where I do these videos from, is under construction as we are still recovering from a flood that we had in our basement. So no video for today, as there's a lot going on here in the background, and with a little bit of a delay as we're waiting for some of this construction to finish before I was able to record this tonight. So we're here now. Apologize again for the delay, and let's go ahead and get started. Today is Monday, September 24th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for tuning in tonight. Welcome to those of you who are watching us for the first time. Subscribe to our YouTube channel by clicking the Market Scholars logo in the bottom right corner of the video. Hit the red subscribe button that pops out. Also, click the thumbs up icon to tell us to let us know that you want us to keep doing these videos, and comment on anything that stands out to you from tonight's Market Outlook. Join our daily Market Outlook email list. Click the link in the top right corner of your screen here. Follow me on Twitter for more content like this throughout the day, and join our Market Outlook community that we have built together on Facebook. All right, let's start off taking a look at the market forecast indicator with on the S&P 500 first. And you see we're rising above 90, so still a strong bullish posture. The short-term sentiment decline with the blue line dropping down into the lower half of the chart. So that bullish run didn't last very long. We're continuing to get frequent moves. So we got 3 days above 50. The expected run 7 to 12 days of the blue line being above 50. So we're continuing to get frequent, small, short, bullish runs. I mean, it is a higher high. We do have a little bit of a divergence with lower highs in the blue line. This is obviously the low point in between. We actually do have a bullish intermediate confirmation signal right now, which is a combination of a bullish posture with an oversold momentum line and the near-term line being below 50. So last time we had something similar was right here. The near-term line was a little bit above 50 at the time. And you can see we bounced the next 3 days off of what is a higher near-term low point. You know, we're going to do that again here. Again, very well could. We might get another day or two bounce out of this. These short-term signals. You know, the near-term line setting up for a bullish low point, a bullish near-term low, higher low point between 20 and 50. Again, we are now close to 3 months along on this intermediate posture that's typically 1 to 3 months. That we expected 2 to 3 months because of the overbought cluster we got initially, kind of that big, nice stamp of bullishness that we got right off the bat. So we could very well bounce off of this in the next day or two, but keep in mind, you know, this, like last time, lasted just a few days, and that was it before we started to come down again. And considering, you know, what we talked about on Friday with the moves that we had on Thursday and Friday being very peculiar, considering the expiration date. That there's still a possibility, especially with the seasonality of this week, post-September expiration, that there's opportunity for volatility. That's the typical pattern. So with those things in mind, the pattern itself here suggests a short-term bounce as early as tomorrow. I would not expect, if we get one, for it to last very long. The last one lasted 3 days to get to new highs. I wouldn't even expect that long on the next one. You know, like I said, the near-term runs are getting shorter. They're not getting as high. The next one might not even get above 80. It might not even spend 3 days above 50. So we'll definitely want to keep our eyes on that and make sure we don't get caught up in thinking, oh, we got strong bullish posture. We get the short-term bullish signal. Let's go for it. You know, that's great when you're, you know, less than a month into a bullish run. It's not so bullish when you're almost 3 months into a bullish run, where you haven't had enough of a pullback to say, you know, to get that dark pink shading where we can get a good solid low point to bounce off of. Let's take a look at the Dow Jones. Evening star candlestick pattern showing up on the Dow Jones. It's been more bullish. You can see its momentum line fell below 5. So same pattern, same intermediate confirmation signal with a strong bullish posture, oversold momentum line that would suggest that we'd bounce, but considering how extremely low the momentum line dropped and the bearish pattern here, I would not expect us to bounce up. And of course, anything can happen, but I would not expect us to bounce up in the short term. The pattern suggests weakness going forward. We'll look at the NASDAQ. The NASDAQ actually bounced today and now has a bullish posture again. So we're back to being bullish, even though we're coming down from what would be a bearish near-term high point. So we'll keep our eyes. Short-term sentiment is mixed, right at the midpoint of the chart, which means the NASDAQ is about as sideways as it can be in the short term. So it really needs to get a good breakout one way or the other. And again, considering the length of time that we've been bullish without pullback, the odds of a break to the downside aren't 100%, but they're getting higher. And then finally, the Russell 2000, it wasn't as bullish. Came off of its lows like everything else, so it has a a weak bullish posture again. Weak simply because it barely turned higher. But again, the near-term line rolling down did not produce a bullish high point, did not get up above 80. Hasn't for the last couple of near-term peaks. We haven't got the bearish lows yet, so we're not on this bearish trend. But again, similar breakout on the NASDAQ would probably mean a breakout to the downside as well on the Russell 2000. Alright, a quick reminder for those that are watching our video on the Market Scholars blog. Remember, if you click this image up here under Join Market Scholars, it takes you to this page where you can subscribe to our site for free. And on our site, you can participate in our forums, particularly our Market Outlook forums up here at the top. Eventually, there'll be some content for free, especially from our blog, it's courses, but the premium content, the classes that you get when you subscribe for the premium classes, you can see there's a full docket of what we teach. With the next upcoming class here, one of Brandon Van Zie's most popular classes is dividend growth investing, is what he's really known for, not just among market scholars, but actually outside of our company. One of our most popular classes that we have, as well as a few others, option classes that I teach tomorrow night and Wednesday morning. Remember to let us know that you want us to keep doing these videos with 3 clicks. One right here by clicking the heart, that like, and then click this like button that will tell us that you liked tonight's Market Outlook tweet. Click this image, it takes you to your Facebook page where you can click and like the Market Outlook post from there. And then finally clicking here. Remember to share. Let's see if we can't get that number to 100. You can share this video with others, either through email or any of these other outlets. Okay, looking at the long-term charts again, it's hard to be too bearish when you're at these levels. So, but what you do is you look for weakness in the bullish trend, and a little bit of a harami one day into this week, so we'll keep our eyes on that. And of course, still got a bullish candle, but we'll watch for that lower shadow to develop here on the chart, considering that we're getting a small buy. Now we already got a higher close, but that close is an average of 4 prices, the close on this Hakinyashi candle. So that can change throughout the rest of the week. So we'll keep our eyes on that and see if we end up closing above yet last week's close, which would be bullish without the lower shadow. Anything different would suggest weakness on the long-term chart. Excuse me. If you look at the 3 green arrow chart, then you see 1, 2, 3 green arrows. So that's bullish. That's why we're shaded green. So good sign there. But when you look at the 2-line versions, you can see divergences continuing to form. MACD rolling down now as we pull back to the 8-day moving average. Stochastics still above its rising moving average, but again, lower highs with higher highs suggest, the lower highs suggest that the peak here on the S&P should be right about where my cursor is relative to the previous peak. That's what the indicators say that it should be at. So the fact that it's that much higher means that this is fluffy. This move right here was fluffy, and Thursday and Friday's move was a little peculiar. So the market could very well correct that according to that divergence. Okay, as expected, we talked about on Friday that the S&P would probably start this week bearish, correcting the moves that we had at the end of last week, and so far that was the case. We gapped down lower. Now keep in mind, when you look at the cash index, which doesn't have that dividend payment, you can see we didn't fall all the way down. There's still some more room for it to go down to get back to where we closed on Wednesday before that Thursday gap and rally. Before Friday's gap and where we peaked. So we're off 20 points off of Friday's peak. It's still about another 10 points to go before we get back to there, and that was kind of the expectation. You can see we did drop to the 50% Fibonacci retracement of that near-term run. The rest of the gap, though, is down here at that 62% Fibonacci retracement. So we'll see, if tomorrow we defy those momentum confirmation signals, intermediate confirmation signals, and make our way back down, simply for technical reasons, back down to this support level, Fibonacci support level. And then what we do from there, you can see where the rest of our support is. In the short term, remember, in the long term, there's more room for it to go down. And again, there's the candle, there's the low point. So we'll see, how we trade and where we trade relative to that. Actually, this is the open to this week's Hakiyashi. So we can actually still come all the way down to 2,900 and still avoid the lower shadow, though at some point in time we will get one as we get this intermediate pullback. And it wouldn't be a bear market, but it would be more of a pullback than just the near-term pullbacks that we've been getting. If we take a look at today's move, and this is what I tweeted out earlier today, if you take a look at SPY and its range, remember we did have a gap. We closed Friday at 291.99. Today's high was 291.50. So even despite the dividend adjustment that's not there, still a 40-cent gap regardless. And then you look at today's range of $1.40. So you're looking at about $1.53 if you include the gap for today's range. Because remember, the gap is the overnight range, so it's still a part of it, just a lot lower volume. The ATR is almost 2 points, so very small range still. And the volume at 53 million after 2 days of above average volume just cut in half here. And when you put that into context, the 53 million is way down here at the low point of this 52-week range. The 1.5 points below the average, and also way down at the bottom end of the range. So that's not a bearish move. And again, you need to have, to get to a plus 1% move, you need to have an ATR of at least 3 points. Not too high, not over 5, to where it'd be too extreme. But 3 points or more gets you into the above 1% range, where you start to get more bearish. Today was not like that. So again, this is the kind of pullbacks we get on bullish trends. They're not very big pullbacks, but they're pullbacks nonetheless, and that solidifies the trend. Remember, trends are higher highs and higher lows. So you're going to have ups and downs on trends. And so when is a down just a move to a higher low on a trend versus a down move that's going to break the trend? Well, if the volume is low and the move is small, then that's just a move down to a higher, in this case, near-term low, with the expectations that will bounce off of that. Again, any bounce off a near-term low right now, though, grain of salt. Do not expect it to last very long, because they haven't been, and do not expect it to go up to significant new highs, because that's not the expect. We are in a mature end phase of this intermediate cycle. At some point in time, we'll continue to diverge in the near term, and that's going to set up weakness for more of an intermediate pullback. And the more we go, and the higher we go without that intermediate pullback, the more we'll get that kind of a pullback, right? Because that was too much, and the market corrected it very, very quickly back in January and February of this year. Let's take a quick look at the volume here today. And you can see volume had jumped up. after this expiration for VIX. VIX here, and you can see it jumped up to 12, a little bit below 13. If you take a look at the relative to VXV, that's the key one to keep an eye on. It's still in the bullish zone. So it bounced up off of extreme low levels, but still easily in the bullish zone, in the lower half of the bullish zone for that matter. So again, kind of hard to be too significantly bearish. It's okay to expect pullbacks, and volatility to move a little bit higher. And the slower it moves higher and the smaller the moves are on the index, the more that's just a pullback, just a nice, good, bullish trend with a move down to what we would expect to be a higher low, and then subsequently a bounce off of that to what we would expect to be a higher high. All right, to summarize, again, the market posture is bullish. We're getting a short-term bullish signal. We don't expect any kind of bullish bounce in the short term to last very long or to go too much higher. We recognize that we are towards the latter stages of this intermediate run, and so far the pullback has been nice and tame. And eventually we expect more of a pullback, but as long as it stays within nice, easy levels, then we can look for it to be eventually a higher intermediate low point that will bounce off of and continue to move higher in the long term to what would be a higher intermediate high point. So what do you think? Do you disagree? Do you agree with that? There's a link popping out as always in the top right corner of your video. Click that link up there and then click either agree or disagree. If you click disagree, remember to scroll down to the bottom and let me know what it is that you're seeing that would be contrary to what we've talked about here tonight. All right, now let's transition over what's driving this price action. You can see busy week coming up, FOMC meeting tomorrow and Wednesday, expected to announce Wednesday with their forecasts and the press conference. Of course, Thursday, GDP, final revision to GDP and a basket of other currency indicators due out as well. And then finally, Chicago PMI and personal income and expenses. So busy end of the week coming up here. And of course, earnings season will be coming up here in a few weeks. So it's going to be a busier time for stocks, especially compared to what we've seen over the last so many weeks. You can see the economic surprise index. So we did have the Dallas Fed survey coming out. Wasn't as strong as expected. But pulled back a little bit, but keep in mind that pulling back from relatively high level. Here's the picture of the chart, and you can see again just how bullish we are and pulling back slightly from really high levels compared to where we were obviously prior to the election. This is for the Dallas Fed. The National Activity Index, which has all of these, you can see it had a strong move higher. You can see it's not nearly as volatile because it's a component of all these indexes, about 85 of them. So it doesn't grow too much, but you can also see too, for most of 2016, trading below zero or trending below zero with a few months above it. Now it's the other way around. Now, we're peaking above 0.5 and with, barely dipping below zero for a brief period of time this year. So, and then bouncing back up. Now with the 3-month average taken here in orange, taking a big bounce up higher than we've seen, the 3-month average at least higher than what we've seen over the last so many months. So of course crude oil was the biggest mover on the day itself, continuing to climb closer and closer to that 3-month. Again, a falling dollar, even though the dollar did come up off of its lows today, falling dollar has gold and crude oil tend to bounce higher, and they've got plenty of crude oil and gold have been trading lower for so long. Crude oil not so much. It's got a little bit of more of a bullish trend. It's got a strong bullish posture here. So it's kind of making its way back up towards its highs. Gold, on the other hand, has really struggled with the strength in the dollar recently. Its intermediate posture is higher than it's been for months, basically since this bearish trend started. So it's looking to reverse that trend and kind of break out of this action, this sideways action that we're having. similar to what the dollar did when it dropped, formed some clusters, bounced, went sideways, and then really kind of broke out here. You can see it. What happened on the dollar? Excuse me. Go back to a yearly chart. You can see we dropped, got a bunch of clusters, bounced, went sideways, and then broke out of that. So again, you would expect if the dollar rolls over again, similar to over here, then the gold would have a subsequent rally itself and make its way higher. You can see the trend on gold, and you can also see a very similar trend here in agricultural commodities, which is really beaten down by the trade, not only the strong dollar but also trade issues. Bonds continuing to drop. Long-term bonds down at their 3-month lows. That means yields are rising, right? And you can see these interest rate sensitive, especially the interest rate sensitive alternative equities, real estate stocks, dividend stocks, MLPs, really declining, dropping sharply. They've had some strong moves, but just like that, real estate's down to its 3-month low point. You can see it's had a really good run, but way below its moving average now, and starting to make a run on the intermediate posture to the downside. And you can see a very similar thing happening with MLPs. Again, it's had a bullish trend, but rolling over and breaking down today. So these U.S. equity asset classes, more of them, they're more specific. They're unique. They're not as broad based, but showing some weakness. You can see dividend stocks with an extreme low in the momentum line, the intermediate line, working its way towards 80, coming off of that overbought cluster that was bearish for it before. The last one we got was pretty bearish, and you're getting some pretty bearish candlestick patterns here as well. So just to reflect on that, the broad U.S. market, and you can see it here, and then there's large cap stocks over here, mid caps, small caps. So we're getting a pretty broad selling across all these different capitalizations. Outperforming ACWI, so you're still getting some weakness in international areas. Basically, as I mentioned on Friday, those really strong emerging markets, basically just pulling back some of the really strong gains that they've had over the past week and a half. I wouldn't read a whole lot into that weakness. I don't think necessarily it's weakness that will get us back to new 3-month lows. I think it's just weakness in a lot of these areas. There's basically Fibonacci pullback of the strong gains that they've had over the past couple of weeks. Even if, for Canada, for example, it's a pretty bearish candlestick pattern there. Same with Brazil. And you can see India really dropping and getting a overbought cluster. It's the only one that's down below its moving average. All the rest of them are easily up above their moving averages, and some of them are turning green. Italy, Korea, Russia has turned green. France has turned green on its moving average. So really good signs for a lot of these areas, all except for India right now. Okay, not surprising with the strength in crude oil, you have some strength in the energy sector. Energy sector is rebounding according to Brandon's new updated sector selector rankings over the weekend. So energy is continuing to move up the ladder from being really, really weak. On the other hand, XLC, this new communication service, is doing well today. There's that rebalance expected that will be a benefit to a lot of these stocks that are in ETFs like this that will get bought up with the change. So a nice good rally there. On the other end of the spectrum, real estate still struggling. Look at the big drop in real estate. Look at the drop in staples. You can see utilities continuing to move lower. Even materials had a big drop in financials. So some in industrials. A lot of these U.S. sectors rolling over. They've been bullish for so long. They're starting to roll over. At least in real estate, it's breaking. And so is staples. So you're getting some weakness, and again, that kind of aligns with the expected intermediate pullback that we're getting. Not that we're going to get bear market across the board, but an intermediate pullback is more than just a short-term, few-day pullback. That's a near-term pullback. Intermediate pullbacks tend to last a few weeks, and they tend to be a little bit deeper. Not, we're not talking 10% correction. We're not talking about 20% bear market, but we're talking about Fibonacci retracement of the intermediate run that we've been on over the past few months. That now we're starting to see weakness in these individual sectors that will lead us, that can kind of show that we're headed towards that type of pullback. All right, for our trade idea of the day, I'm going to take a look at the technology sector, which has been weakening, has been lagging behind, and of course, big changes coming up within that sector. One stock, Cisco here, which has been doing really well, bouncing up, but you notice with the strong volume, with a little bit of a breakout move we saw pre-expiration, big time divergences setting up on both the MACD and the stochastics going forward. We've seen this before, heading into March expiration and coming out of that 6 months ago. So, if we get some kind of bearish move again, are we gonna, what kind of moves would we expect to see heading back towards, these old high points right around 46 or so? This old low point that happens to line up. You take a look at some of the other indicators on Cisco. You can see again overbought cluster that we got right before the September expiration, with the Harami pattern coming out of it. So there's, you can see overbought clusters haven't been the most. They've been signs of weakness in the past, especially when we've been as bullish as we've been for so long on this chart. You take a look at the long-term view for Cisco. Here we go. Again, you can see how bullish last week's move was, and again the long-term divergence setting up for a deeper pullback here. We're not looking for as big, because remember, we're only looking for an intermediate pullback to occur on the market as a whole, with a rotation that's occurring where technology now may be expected to lag behind other sectors, not necessarily drop, but at least lag behind other sectors. And so this would be one way to take advantage of that. We can look to do a bear put spread by saying, okay, I'll for this November expiration, I will says a little bit longer than normal, but I can sell that 47, buy the 49. That would give me, it would cost me less than $1, and I can make a little bit more than $1 if we were to get down there. And we don't expect it to be too bearish, so we can say, okay, well, to cover the cost of that debit, I'll sell that put at 47. So now, if you notice, if I were to analyze that trade, there we go. And I think I already have one in there, so let's get rid of that one. You notice if I were to analyze this trade, if this stock keeps going up higher and higher and higher, because that's the trend we're on, then we've covered, right? The would be worst case scenario for the bear put spread. I wouldn't make any money on that. I'd make maximum loss, but my credit I get from selling the 47 put, as long as we stay above 47, offsets that. If we pull back towards 47, that's where I make the maximum return of about $200. And let's see, if I were to confirm and send, it'll take about $900. So a high probability trade, whoops, let's analyze that again. A high probability trade, considering I got an 81% chance of making something. The only time I'll lose is if it goes back towards that 45 level, which you can see on a long-term basis where they're, what that looks like here. If I were to take a look at the two-line version and see where that break-even level is. Okay, I've got these old highs back here, and of course also you see the Bollinger Bands to look for some volume support, and you can see, okay, that's the top end of this 70% range, is a little bit above 45. So there's some opportunity for it to halt that pullback right above 45. We'll be able to maintain some kind of gain on this and a pretty decent return on the $900 capital requirement for entering this trade. So again, doing a bear put spread 47.49, a little bit bearish, trying to make some money from a pullback, knowing that we don't expect it to be too bearish because we're just expecting a pullback, and we might even pull back a little bit further and then bounce. And then that's why we say, okay, well then we'll sell the 47 put to completely cover the cost of that bearish spread. So now I can still make money if we go down below 47 a little bit here. So again, with just the bear put spread, I make maximum gain below 47. So I can still make something below 47. But if we do continue higher on the trend, then I don't lose anything at all. Because of the credit I get from selling the put short, and put together, that's called that back ratio spread. Alright, so that wraps us up for tonight. As always, apologize for the delay in the video and the under construction that my office is going through right now, with keeping me from being able to have the camera on this evening. But things will be back to normal. Brandon will be back on tomorrow night, and then I'll be back to normal Wednesday again. So thanks again for watching. Remember to subscribe to our YouTube channel. Click the thumbs up icon. Let me know that you want us to keep doing these videos. Comment down below. Follow on Twitter for more content like this. And join our Market Outlook community on Facebook. Join our Market Scholars community on our website for free. As always, thanks again. Have a great rest of your evening, everyone, and we'll see you all tomorrow.